Do you have a 401k? If so, then you need to be aware of the government's new rule changes as it pertains to retirement accounts. In this video, I'm going to be breaking down all of the important changes to 401ks that are happening in 2024. If you want to optimize your retirement savings, comply with all the new rule changes, this is the video that you're going to want to watch and that you're going to want to share with someone who is employed or self-employed. Without further ado, let's dive in. Secure Act 2.0. If you have not heard of the Secure Act 2.0, it is a piece of legislation that was signed into law in late December of 2022. This act made major changes to retirement rules, and these changes were designed to address some concerns with retirement in America. For example, surveys conducted by the Federal Reserve found that 25% of non-retirees have zero retirement savings at all, and only 40% feel that their retirement savings are on track. This means that the majority of people who are not yet retired in America either have no retirement savings or they feel that the savings that they are generating will not be enough for them to live comfortably once they do retire. The government started to address some of these issues with the Setting Every Community Up for Retirement Enhancement, or Secure Act, which became law in 2019. The Secure 2.0 Act was created to finish the job that was started with the original Secure Act. Here are some of the biggest changes to 401ks that are going into effect due to the Secure 2.0 Act and other changes that the government has made for 401ks. Number one, contribution limit changes. Right off the bat, contribution limits are increased for 401ks in 2024. In 2023, the contribution limit was $22,500. Now they have increased it to $23,000. So you'll be able to contribute an extra $500 to your 401k this year. And if your employer happens to match your 401k contributions, this will mean that your employer will also be able to contribute an extra $500 to your 401k. Now, increased contribution limits means that more tax-advantaged retirement accounts will exist. So this is a nice change. Number two is additional penalty-free withdrawals. Typically, if you're under the age of 59 and a half, you will face a 10% penalty on any money that you withdraw from your 401k. There were some exceptions to this penalty in the past, such as being totally disabled or permanently disabled. However, the government has dramatically expanded the number of exceptions for the 10% early withdrawal penalty. For example, people who have experienced a personal or family emergency will be able to withdraw up to $1,000 per year from their 401k without having to pay the 10% penalty. This exemption can be extremely valuable for people who have gone through some sort of major crisis in their lives during the year who need access to funds from their retirement account to help them recover. The government is also now allowing people who have gone through domestic abuse to make penalty-free withdrawals up to a certain amount as well. Now, if you have survived domestic abuse, the government will allow for you to withdraw the lesser of $10,000 or 50% of the account penalty-free. I personally think that this is a great thing that the government has done here. The reason why is because domestic abuse it's a terrible thing, and a lot of people who are going through it desperately need access to money so that they can use that money to get themselves out of their situation that they are stuck in. So hopefully you're not in this situation and you never will be. But if you do find yourself going through domestic abuse, just know that you can now take money out of your retirement account penalty-free to help you. Also, just understand this. You are allowed to self-certify that you have gone through domestic abuse. So you don't have to provide a police report or any other type of evidence. You can just tell the IRS by calling them that you are a victim of domestic abuse and you want to make a penalty-free withdrawal from your 401k. You should have no problems, but if you do, seek the help of a tax professional to assist you with this. The next rule change with 401ks is employer matching for student loan payments. Guys, this is another great change that is happening to 401ks this year. Right now in America, student loan debt is so out of control that a lot of employees are unable to save up for retirement properly because they have to make large monthly payments to their student loans. It often takes student loan borrowers years, if not decades, to pay back these loans. Many employees who have significant student loans have to choose between keeping up with their student loan payments and contributing to their retirement accounts like 401ks. Now, thanks to the Secure Act 2.0, employers are allowed to consider student loan payments as elective retirement contributions that are eligible for matching contributions. So, to understand what this means, let's just say that you make $50,000 per year and you have a student loan bill of about $500 per month that's kind of preventing you from contributing to your 401k. In the past, your $500 student loan payment will not have been considered a retirement contribution eligible for a matching contribution from your employer. However, now it does. So essentially, the government now views paying down student loans as a way of contributing to a retirement plan. So back to the example, if you paid $500 per month or $6,000 per year towards your student loans, then your employer would be able to make matching contributions of $500 per month or $6,000 per year towards your 401k. If you're someone who had both student loans and a 401k with employer matching, then this is fantastic news for you. And make sure you share this video with other people you know who have student loans because it could help them too. Here are some of the changes to Roth 401ks. If you have a Roth 401k, then you used to be required to start taking minimum distributions from these types of accounts in your early 70s. But under the Secure 2.0 Act, there are no more RMDs, which stands for Required Minimum Distributions. This means that if you have a Roth 401k, then you do not have to start taking distributions in your early 70s. Now you can wait until your mid 70s, your late 70s, your early 80s, or beyond. This rule change benefits anyone who wants to wait longer into their elderly years to start tapping into their retirement funds. So if you plan on working until you're over 75, or if you would simply like to use other sources of income, such as rental real estate or dividend income to fund the early stages of your retirement, then this rule change can be very beneficial for you. The reason why this rule change is a benefit to certain people is because the longer you wait to start tapping into your Roth 401k, the more that the account can grow and the more money that you will ultimately be able to have inside of the Roth 401k account. Just be careful not to make the same mistake that some people make, which is waiting too long to start tapping into their accounts. Because if you wait too long, you might not actually be able to use the funds as you head into your later years of life. All right, we've covered a lot of information on 401ks today, so congratulations on making it this far. I know a lot of you watching this video have 401ks, so this information is going to be immediately important to you. Here is a quick summary of the most important points that I discussed with you today that I would like for you to walk away with. Many changes have occurred for 401ks, and a lot of these changes were created through the Secure 2.0 Act. Contribution limits are increasing. They're now at $23,000 for 401ks in 2024. The government has created early 401k withdrawal penalty exemptions for people who experience emergencies or domestic violence. Student loan payments can now count as 401k contributions for employer matching purposes. There are now no required minimum distributions for people who have Roth 401ks. So guys, the bottom line is that many rules for 401ks have now been changed. Although I covered a lot of information in this video, I would actually recommend that you speak with a tax advisor to learn more about all the changes to 401ks that are happening this year and in the coming years. If you do want to learn more about changes to 401ks, then feel free to get in touch with my tax strategy team. You can book a complimentary consultation after filling out a questionnaire below. You can also find a link to my ebook. The ebook is called The Short-Term Rental Rule. And the reason why is because in this ebook, I will teach you a powerful tax code that will allow for you to use short-term rentals to break down your W-2 and 1099 taxes and possibly even make you tax-free. I've included a link to my free webinar. In this webinar, I teach you some of the most powerful tax strategies that the wealthiest 1% of Americans are using every year to save a huge amount of money on taxes. Thank you so much for joining me on this video today. I hope that you liked this video. Feel free to comment, like, subscribe, and I look forward to seeing you on the next one. Cheers.